It sure does seem that investors are impatient. They're anxious to get money to work. What are you telling them?
Well, I think what we're recognizing today is, and we spoke back in August, is that we, typically go through, a phase of like survival in credit when there's a dislocation to recovery to prospering. And right now, we've really experienced a lot of those in a very compressed period of time. So what we're telling people now is, for credits that have actually prospered in this environment, and there have been a number of them in the healthcare and tech space, we're looking to just invest in them in a regular way credits as going concerns. There's a lot of opportunities where companies are looking to transition, if you will, to look to the end of this pandemic, which thankfully with the vaccine seems to be coming near to an end, and how we can help those companies get there. And then finally, a lot of people are talking about the distress cycle, which we're not seeing just yet, but we're watching very closely. So it's really looking at all three of those strategies in tandem.
Right. So your colleague, Jason Thomas, had written this report recently, and it really points to the spike in the high yield default rates. It makes the point that we're at historically high levels of indebtedness of corporate America. How are some of these issues concerning you?
Well, I think, as Jason wrote in that paper, that we've got a spike, obviously, in leverage in companies. I think we also, with the low interest rates, are actually at debt service levels that are actually comparable to, sort of more prosperous times, if you will. But I think that the main concern is that we've now got companies who've solved their liquidity issue. And the question is, are they actually solvent? So i.e., is their going concern value going to outweigh the amount of debt indebtedness that they have? And in particular, when we get to the other side of this pandemic, will those capital structures support that new world of growth that we're going to experience for those companies? And I think that's really the focus of that paper, is to say we've dampened, probably for the next 12, 24 months, we've dampened that default cycle, right, but we've really pushed that issue out.
Well, if we push that issue out, there's a lot of talk about the zombification of companies. How are you thinking about that issue?
Yeah, I mean, for us, it's an opportunity to some extent, but also it's also a threat. So when we're investing in transitional companies that we believe when they get to the other end, when they actually, when we come out of this pandemic and there is a more sustained recovery, that those capital structures are actually going to work. And that's really transitional capital, helping companies get to the other side with an appropriate capital structure. So there's a lot of those opportunities because some of those companies just don't have access to the regular way capital markets. And then secondly, it's identifying, following, and figuring out how to get involved in these companies that are going to have to go through some sort of restructuring. And so really, again, it's pursuing two strategies in tandem on behalf of our investors. Mm-hmm. And that's enhanced by the fact that today, really understanding the enterprise value as business models are going to change, mm-hmm, as we come out of this pandemic, is really leveraging the platform of a broader firm to help understand those business model changes that we're seeing in our broader portfolio today.
As a credit investor, another question that is underpinning the market is inflation. What are your inflation expectations?
Well, I think I'm a credit investor. I'm not a good macro investor, so I won't put my point of view out there. I think what I would say in terms of inflation, what I would worry about as we come out of this pandemic and through into a recovery is there's a lot of pent up demand, right? There's been so much demand destruction in certain areas. And also there's issues around the globe with global trade agreements or lack thereof, and the type of disruptions that's caused in supply chain. So I believe that as we come out of this, I'm more concerned about the bottlenecks and inflationary pressure in certain areas that affect certain industries as opposed to macro inflation. But certainly, over a long period of time, would we expect some inflation? Sure. But I'm more focused on how it affects the underwriting of credit in specific industries.
Well, speaking of specific industries, you pointed to the idea that we might start to see some more distress. How does that start, and when does that start to play out? The Fed has really lifted a lot of tides this year, and I think that idea of distress is something a lot of people are looking to get to work in.
Yeah. Well, I mean, if you think about what's happened so far, really 2/3 of the defaults and sort of restructurings that have happened have really occurred in retail and energy. I'm sure you've heard that before. And those were sectors that were having troubles before the pandemic. So it just accelerated that. To your point, a lot of companies have just been, given that liquidity bridge to some point in time. And really it's going to impact companies that can adopt to this new environment where if you look at anybody's portfolio right now, what you've noticed is the winners have been the ones who've been able to adapt technology to interact with consumers and businesses in a more effective, efficient way. And there's going to be plenty of companies that aren't going to adapt to that. And I think they're going to have capital structures that will require restructuring. And that's where we're going to focus.
So it's early next year, finally, the time for you to start distress investing a bit more.
I think it's still early. I mean, what's happened is the ability to enter, like when you distress invest, I mean, you have to enter into that either through a company either going through a process or us buying their securities in the secondary market. And the challenge right now is because everybody's been provided with liquidity, prices are high to buy in the secondary, point one. And number two, people have that liquidity line to keep them going. So I actually think, we'll start, I don't want to predict, but it just doesn't feel like, we're going to see a rush of distress in 2021.